Hey there, everyone, and welcome to this Friday edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets. Today, a special all-mailbag edition. It's so much fun. I'm so glad we started the mailbag a couple of years ago, and it's been a pleasure to hear so many questions. It's helping us to think about what areas we want to focus on the show and what other content we want to bring to you on Stock Charts TV. So before we get to the first question, my first thought is keep the questions coming. Our mailbag can always use your question, and we'll hope to answer one of your questions in our next mailbag episode. Email is best, thefinalbar@stockcharts.com. On X, just tag us in a comment at FinalBarSCTV. And here on our YouTube channel, just drop a comment below the video that you're watching. We appreciate your feedback, especially your questions. We'll hope to answer one of yours in our next mailbag episode. With that as a start, let's get to question number one. Dave, how would you apply Fibonacci retracements to KRE? KRE, if you're not familiar, is a regional bank ETF. And KBE and KRE. KBE is a bank ETF. KRE is a regional bank ETF. So two interesting ones to sort of think about the financial sector. You shared this chart with you, and thanks again, person who sent in this first question. You included a permalink. And as a reminder, on Stock Charts, if you're using our Sharp Charts engine, below there you'll have a little link that says permalink. On our new Sharp Charts engine, it looks a little bit different, but still kind of there. You have this little link, and if you click on that, this hyperlink right here is what you want to send me. On ACP, there's a similar function to what you see here. Send me that with your question, and then I'll be able to look at the live version of whatever chart you're looking at, which is super helpful. So first off, my comment to you before I answer your questions about Fibonacci retracements, my friend, you have a lot of different technical indicators on here. I would argue maybe a couple too many. If you think of the charts that I show on the channel, they tend to kind of look like this. Pretty straightforward. It's it's the price and then a couple different indicators. And the reason why I do that is because I want to make sure that I don't overanalyze, I guess, or have what's called analysis paralysis. If I had this many indicators on my chart, I would probably start seeing things. I would start seeing signals as opposed to seeing more of a clear picture of what's happening with the stock. So my first suggestion to you would be try to simplify. I would look at a lot less indicators than this. Having said that, you asked particularly about Fibonacci retracements, and generally speaking, I would say I appreciate the idea of using Fibonacci retracements now, which I would totally agree with. And the reason why I would say that's the case is because you have this big run off of the October low to the high in December. And when you have a big move and then you start to pull back within that range, that is literally the perfect time to be using Fibonacci retracements because it's designed to help you identify potential areas of support once you've established sort of a broader range. The only issue I have with precisely where you've put the Fibonacci retracements is what you're doing down here. So you're actually using a strange level. You're using the open of that low bar. So I've seen people, and I'm going to edit your chart here just for a moment. So I will tell you this. When you put Fibonacci retracements, I've seen, and general practices are either you use the intraday low, right? Use the extremes, which I tend to subscribe to, or you use the closes, which would mean you use sort of the close of that low candle. And if you're doing that, you'd want to use the close of that top candle as well, and that's sort of your framework. I'm a fan of using the intraday highs and lows, so I'm going to tweak your levels here. This is not a level I think you could probably justify very well. So here using the low around 37.35, and I'm kind of really close with that, and then the high around 54, that would make sense to me. So I'm going to do that, and then that's fine. All right, so now that I've kind of updated the levels, what does this tell you? So this tells you that the first level, which is a 38.2% level, it's labeled 61.8, but they're kind of inverse of one another, is here around 47.60. We broke through that level. We've now tested the 50% level here around 46, and you can see we've now bounced off of that point. So, the next level of support I would be looking at would be 43.80, we'll call it, 43.70, which would be the 61.8% retracement of the way back down here. And the way Fibonacci retracements generally work is you expect support at the first level. If and when that breaks, you go to the next level. So when it breaks through this first horizontal level, you go to the next one, the 50% line. And if that holds, there's your support. Now we'll call 45.60 or so, that 50% level. If that would break, then that opens the door to the next level. So it's really designed to help you identify what you might call pivot points, sort of key levels of interest between two extremes. So at this point, I would say, regional banks holding that 50% level using Fibonacci retracements, pretty interesting. While I would say you probably have too many indicators happening on this chart at one time, I would say validating what you see with Fibonacci retracements using other disciplines like candle charts, an oscillator like RSI, you have the stochastics RSI, looking at a small number of indicators to confirm what the momentum actually is as you're approaching that level, I think is a really good general point of view. So thanks for sending that chart. Try to simplify a little bit, but overall, I like your use of Fibonacci retracements for regional banks. Let's get to question number 2. Dave, how do you attempt to predict reversals once a stock has broken to an all-time high? Topical question because there are a lot of NVIDIAs out there that have just had these incredible runs. And I'm trying to think of what chart to use. There are a bunch of them, right? Insurance names, trucking names, a lot of growth stocks sort of have this general appearance. In NVIDIA, just an incredible breakout above a basing pattern and then a nice run higher. So, how do you attempt to predict reversal? So the first thing I would say is NVIDIA and charts like this have had incredible runs. And before you focus too much on, are we overextended? Should I be selling NVIDIA? I would first point out the benefits of looking for breakouts, right? So I know, having done this for a couple of years, when a stock breaks to a new high, I remember before I worked for a big growth shop, a big money management operation, I was super skeptical buying new highs because it felt like you were too late, right? Why am I buying new 52-week highs? It's already had a run. But this is exactly why NVIDIA has had an incredible breakout going from 500 to over 700 just in 6 weeks. But that all came after it first appeared on the 52-week high list. So if you question the sanity of looking at new highs because it might be too late, charts like this are why you look at new highs, because strength tends to beget further strength. Now, when you keep getting to new highs, at some point we get too far, right? And at some point, a stock like NVIDIA, I'm told, will have to correct. It's not happening today, and it doesn't seem to be happening anytime soon, but at some point it's going to happen. So when a stock is making new highs and you look to the left and there's all daylight, right? There are no resistance levels to think about. What do you do? So I would say you have two general approaches. Number one, you try to anticipate a high. Number two, you try to confirm a high. And ideally, you do a little of both. Trying to anticipate a high means you look for things like price momentum, right? So we're overbought. Look for the stock to make new highs on weaker momentum. That's what's called a bearish momentum divergence. We've highlighted those on the show before. NVIDIA is actually not showing that because the momentum is actually quite strong as it goes higher. But other stocks that I could show you, the price is going up, but the RSI is actually sloping downwards. So that's one indication that price is still going up, but the momentum is weakening. A lot of times simply looking for a chart that's overbought and then it comes out of that overbought region, a lot of times will tell you that an uptrend may be at least pausing or no longer going higher, right? So indicators like RSI, when used to measure momentum and look for momentum that is slowing, right? So when the price is doing something but the momentum is not confirming it, that would be sort of a leading indicator way of thinking about it. The other thing I would do is put on sort of your trend follower hat. And this is where, like the trend line that I show you on the S&P 500, this is kind of the general approach that I'm using here. I'm not saying that this trend line is going to help me pick the top. Maybe a couple days ago, maybe that ends up being the high for the first half of 2024. I don't know that yet. It's too early to really make that sort of determination. But I would tell you that a trend line that is tracking the lows, when that's broken, it basically tells you that that high that we just had, that's probably a pretty important high that you want to pay attention to. So I'm giving up that initial sell-off because I'm waiting for us to confirm the breakdown. So that's more of a trend following approach, looking for when we break down through a trend line or break down through a recent swing low or a moving average. That's not meant to identify a top as it's happening. It's meant to identify a top once it's occurred. And there's a lot of money to be made by unwinding or going short after something's already started to come down, because that tells you that the uptrend is no longer happening. There are other techniques we don't really have time to go into, but there are projection techniques using things like Elliott wave analysis and Fibonacci projections, which actually take a particular move and then project further highs. And maybe in future episodes, we'll be able to tease those out as well. But that would be the third way, is basically coming up with price objectives and sort of anticipating at what levels we might experiment or might experience a particular level. So those are three things I would generally go with. And the first two are pretty widely accepted that I would encourage you to think about. RSI is sort of my leading indicator. Trend lines and moving averages are my lagging indicators, and I would encourage you to think about both of those on some of those leading stocks that are still working. And as long as they keep going up, chart's working fine. Next question, Dave, how does Dow Theory make sense when the largest shipper, Amazon, is not included? You actually had a really thoughtful question that I boiled down into that one so we could fit it on our screen. But you talked about how can Dow Theory make sense because the largest shipper in the US is Amazon. It's not UPS, it's not FedEx, it's Amazon. Amazon's not in the Dow transports. If you look at semiconductors, that really doesn't include a lot of things as well. So how can we look at Dow Theory? How is that even relevant? And I 100% hear you. So, I actually have 3 charts that I tend to review. The one is traditional Dow Theory, and I don't even know where that chart is because I don't look at it too much. I actually do know where it is. I think it's in here. I have a chart called Dow Theory, I want to say. Yeah, there we go. Dow Theory, new Dow Theory, and the new Dow Theory. I've experimented with different versions of this over my career. So this is as close as we can come to Charles Dow's original work. Now, let's remember, it was 125-ish years ago when he's creating this sort of approach. So the fact that it doesn't map well to 2024, I don't think is that unreasonable. So I like to think about what he was actually trying to accomplish. What Charles Dow came up with was you had the Dow Industrials, which were literally like GE kind of companies, like big industrial 3M kind of names. And then you had transports, which were like the shipping companies to get all the goods from the manufacturer into the consumer's hands. And so by looking at those two pieces, you could measure the producers and the distributors of goods, and that was a great way of measuring economic strength or weakness, and recognizing when there might be a hiccup in the supply chain somewhere because one of them would break out and the other one wouldn't. So the best version, or I guess the modern version of those indexes, are the Dow Industrials and the Dow Transports. But as you very rightly point out, the construction of the Dow Industrials, it's 30 stocks, and it's not a lot of traditional industrial companies. There's some banks in there, like Goldman Sachs is a Dow company. A lot of big, huge weights in the S&P, huge weights in our benchmarks are not in the Dow, and something like Amazon or Target or any of those names really don't map well to this idea of because they have their own distribution systems built in. The Dow Transports has a bunch of airlines which do some shipping, but it's not really their primary business. So, this is a great measure of the modern economy. 100% agree, not so great. So an updated version that I've used for years has been this one, the S&P and the NASDAQ composite, thinking that this represents more the old economy and the new economy, right? The old economy sort of value-oriented names and the new economy growth-oriented names. The problem that I have with this is as the markets have evolved here in the last couple of years and as we've had an AI-fueled, growth-oriented, narrowly led bull market phase driven by the Magnificent Seven, these indexes are basically tracking the same thing because they're both dominated by that same group of 10 to 20 stocks that dominate in terms of size of the weights because their market cap is just so huge because there's such a concentration at the top of our benchmarks. And I mentioned it earlier today on an interview, the top 10 stocks as of last week when I looked, top 10 stocks in the S&P are the same weight as the bottom 420 stocks in the S&P. That's how top heavy our benchmarks have become because of that mega cap trade. So these two charts are kind of confirming the same. I mean, they look almost identical because they're looking at the same stuff. So my best effort to do a modern version is looking at equal weighted benchmarks. So I'm looking at an equal weighted S&P and an equal weighted NASDAQ 100. I'm not 100% convinced on this. I haven't written a book called The Newer Dow Theory by Dave Keller where I explain why this is the best thing ever. I think it's still a work in progress. And if you have ideas, I'd love to hear about it. It's on my rainy day list to dig into it a little more. But for me, looking at an equal weighted version does accomplish the idea that it takes the overweight of the mega caps out. It's a good way of looking at different parts of the economy, sort of the old economy and the new economy, and it recognizes more the importance of value-oriented stocks to tell you about the strength in economic conditions. So at this point, any of those things that I've shown you are pretty bullish. The original Dow Theory is actually not because transports are still pretty low, but I don't put a ton of weight into that here in 2024. This sort of what I call the newer Dow Theory, I think is the best representation. At this point, it's still pretty bullish. So equal weighted versions coming down, I think would be a good sort of Dow Theory-ish sort of thing. And these obviously do include Amazon because they would be in actually both of those two benchmarks. Next question. It feels like most people gravitate to a bullish or bearish bias based on short-term market direction. Would you agree? I 100% would agree. And actually, that is a well-documented phenomenon. So you're not crazy by realizing when the market's popping up, it seems like everyone's bullish, and then the market sells off, and all of a sudden everyone's bearish. and you have that sense of things. And that's with market strategists. I would say that is a natural tendency that you literally have to actively fight. And so, you have to really fight this. And as an individual investor, as an institutional investor, you run into that same thing. This is actually a documented bias called recency bias, or the recency effect, which is whatever just happened, you kind of naturally assume it's going to keep happening. And that can get you into trouble because one day does not make a trend. And when you have an initial sell-off on a day like yesterday, I don't think it's reasonable to make broad changes because of one day's price action. And I always tell people, make long-term decisions with long-term data, make short-term decisions with short-term data. So if you're trying to think about a broader asset allocation, I would not be looking at one day of anything to sort of draw conclusions. It's a moment in time that you're paying attention to. So how do you sort of fight that natural tendency, which I would agree is 100% true, and I have to fight it myself? For me, it's all about routines. It's all about having a consistent process. So I do what's called a morning coffee routine. Actually, you can get to that. I'm trying to think of where I get to that. Yeah, I go to go to Charts and Tools in the upper left. And down here somewhere, there's going to be a thing called Chart Packs, which I know is here somewhere, and I should know where it is. Here we go, Chart Packs. If you look through these are different chart packs that our different experts and contributors have created. This one called Dave Keller's Morning Coffee Routine Chart Pack. I would encourage you to check that out. It's free for our members. You can actually copy my list of charts to your own login. You can go through them on your own. What it basically does is replicate these Chrome bookmarks that I use every morning, and I go through this same list of charts. And it goes through broad market analysis. I start with a weekly chart of the S&P and a daily chart of the S&P. I kind of skip these two. And then I go down to equity indexes, non-US markets, other asset classes, breadth indicators, sentiment indicators, key ratios, sector rotation, industry trends, individual names, and then I go from there. And that's kind of my general way of breaking down the markets every morning. The idea with a morning coffee routine is you go through the same set of charts every morning. And so having that consistent process of going through charts is what actually, for me, helps me identify when things are changing. So it's not like I just randomly bring up the chart of the S&P and then make my analysis and say, okay, this is probably bullish or bearish. Because if you do that, then you're very quickly going to fall into that recency bias sort of framework. By looking at the same chart every day, you have an updated point of view every morning, and all you're doing every morning is not trying to relearn it and sort of focus on what's happening. You sort of have a well-documented, internalized sense of what the markets are doing, and then you're much better equipped when something's different. I would also tell you having trend lines using alerts has been really helpful for me, because what that means is whatever happened today is nothing unless we break this trend line. For me, that's when it's something I need to worry about. So I would tell you the trend on the S&P, the primary trend is still up until we close through that trend line. We still haven't done that. And so, watching for that sort of break, watching for a price alert, a particular level, what we call a line in the sand, I think that's where you want to try to get to. All right, we're going to continue on with our questions here. Before we do, I had a couple of quick announcements to let you know about. Number one, we are currently surveying all of you, our viewers of the Final Bar and Stockcharts TV. We are in the process of evolving our channel here on YouTube. We would love to have you help us figure out what this channel should look like. So if you like the Final Bar and what we are doing, if you think what we're doing is horrible, anything in between, we would love to hear from you, particularly specifics about how we can upgrade things. Should take you 5 to 10 minutes at most. You can scan the QR code on your screen and take a few moments to help us make sense of how we can improve this channel over time. We would super appreciate it. Also, to let you know, I actually have a webcast coming up next Tuesday, the 20th, 1 p.m. Eastern. This is with Market Misbehavior, called Momentum Matters, How the Pros Use RSI. If you've watched this show for a while, you know the RSI indicator is something I use all the time, every day. On most of the charts I look at, particularly on individual stocks and ETFs, I use RSI as a measure of price momentum. So we will talk about that indicator. I'll show you a bunch of examples about how it's calculated, how I use it, and some ideas about how you can use it in this current environment. You can sign up for that free event at marketmisbehavior.com/RSI. And I'll hope to see you next Tuesday for that webcast. Let's continue on with our next question. Dave, given the outsized influence of the Magnificent Seven stocks, might it be better to use RSP instead of SPY for relative strength? I heart your question very, very much. And what you're referring to is when I'm looking at the chart of NVIDIA, and this is my kind of go-to individual stock chart, at the very bottom, I have the relative performance of NVDA to the SPY. And 99% of the time, that's the ratio that I'm looking at. Your point is well taken, which is if the SPY is so top heavy, why use that as your denominator? Here's the answer. If I would put the RSP at the denominator, number one, an equal weighted ETF is something that very few people actually trade, right? The equal weighted ETF and the equal weighted indexes are really more indicative. It really tells you a broader sense of what's happening with those stocks. But in terms of institutions, in terms of a lot of individuals, very few people actually own the RSP and are weighted to have equal weighted exposure to the stocks. Most people own a fund, or they own the SPY or the QQQ or some broad cap-weighted, top-heavy benchmark. So if my goal is to own things that are going to help me do better than just a passive product, I want to benchmark to that passive product. So I've used the SPY, and that probably comes from years working with institutional money managers that were always trying to outperform the S&P. But if I was working with a portfolio manager that had a small cap growth benchmark, we would always do the ratios to that benchmark. So the denominator needs to be whatever you think is that thing you're trying to outperform. Grayson Rose, who's been on the show a number of times and does a ton for Stockcharts and Stockcharts TV, he uses VTI, which is a broader ETF. I would argue they're very, very similar. I don't think there's a huge difference between the two, but for him, that's kind of his main passive benchmark. So I love the fact that comparing it to that thing is what's most important to him. So my question would be to you, what are you trying to outperform? What are you trying to do better than? And so for me, my default position would be owning the SPY or some SPY-like thing. And so I want to do better than that. And so I want to own things where this relative line is going up. The reality is most people have a cap-weighted exposure to those names. And so that's what I'm trying to do better than. That's why it's on my denominator. Great question. I would say there would be some benefits to doing things relative to the RSP, just as an indicative idea of, is the stock doing better than an equal weighted benchmark? But for me, again, SPY is the most important denominator. Next question, Dave, why does the market dashboard track the S&P 600 index, but the new market trend widget uses the Russell 2000 instead? Well, I love the fact that at least one other person than me has actually put the Keller market model on your dashboard. So kudos to you for upgrading your dashboard. This is really fun. The development team was awesome to add this, and this is the first version. We'll add other ones. And this market model is something I refer to all the time with my Market Misbehavior Premium members. My weekly report starts with this model every week, so it's pretty cool to incorporate this as a visualization tool. We have some upgrades that we'll work on through the course of this year. Your question was this: why do we use the Russell 2000 here? And why is the S&P 600 small cap up there? I mean, it's debatable, to be honest with you, which benchmark is better for small caps. I think the reason to use the S&P 600 is because the other 1,400 names basically in the Russell 2000, there's a lot of junky stuff in the Russell 2000. That's 100% true. So the weakest, junkiest names in the Russell 2000 are pretty rough, because these are small companies that honestly have no hope of getting bigger and really surviving. And so there tends to be sort of a natural negativity to small caps, because a lot of small caps just kind of go away or go under, to be honest with you. So Stockcharts for years has used the S&P 600. This was designed well before I joined Stockcharts. Might have been a John Murphy thing because he helped to sort of create a lot of the methodology that Stockcharts employs. I've always used the Russell 2000, and that's just from working with a lot of small cap fund managers who are benchmarked versus the Russell 2000 or Russell 2000 growth or value. So that's a group that I remember analyzing very often. I've always focused on. So this is my background, and so this is the one that I would use. To be honest with you, there are benefits to looking at both of them. I would argue that looking at one of them, at least one of them, would be really, really helpful. I find a lot of people think of the equity markets as the S&P 500. If you look at mid caps and small caps, and hopefully we reinforce that enough on the show, that's broadening your awareness of different cap tiers, as we'd call them, and what some of the smaller indexes could do. And I would say with both of those, with the S&P 600 and the Russell 2000, which you have to remember, the sector weightings are what are most important. So when you get down to the smaller cap benchmarks, it's a lot of things like industrials, financials, healthcare. These are sectors that are way more overweight in the small cap space and are much smaller weights in large cap. So recognizing that difference of structure in the different benchmarks can be really helpful as well. So that's why. That's the answer. Next question. I've read that the money flow index is essentially the RSI indicator, but it includes volume. And I don't mean to laugh as I'm reading your question. I'm so sorry, but I'll continue. If that's true, why isn't it used more instead of RSI? And I'm laughing at it. That's not actually true. So whoever said that's probably summarizing, and that's the kind of thing I would say to a group if I'm really trying to keep it super high level. Look, think of the money flow index as an RSI with volume. That is how I would summarize it, but it really isn't true. There's a little more nuance to it. And by the way, I'll point you the article that I would read. Whoever asked that question, and if you're interested, check it out. So what you want to do is click on the magnifying glass, type money flow index. You'll get to the chart school articles where you're going to look at and get to this article here, which literally explains, for every indicator we have on our platform, we'll tell you what it is, where it came from. If it's in the public domain, which almost all of these are, we'll show you the exact formulas we're using. We'll show examples. Here we have an Excel spreadsheet from years ago where we show you here's how it's calculated, and that's really inspired by Wells Wilder, who in his book Unveiling RSI and DMI and ADX and Parabolic Systems, he literally had a handwritten accounting ledger in the book, which is pretty cool to see how he was calculating them. But we'll actually let you look at the Excel spreadsheet so you can see the formulas that we're using. So when you look at the money flow index, it actually looks very similar to RSI. So I get that analogy, and I think that's a good way to probably think of it. It's kind of like an RSI, but for volume. I guess I'm okay with it. But is it really? No, it's not. And so there are some differences between the two. Money flow index, I would say, is sort of an attempt to improve volume, right? So if you're looking at daily volume readings, it's super noisy. What something like the money flow index is, I would think of it more like on-balance volume, Chaikin money flow, accumulation distribution. These are all indicators we have on our platform, which are basically ways to improve your analysis of volume. So I would think of it more that way. It's not an RSI with volume. It's more like volume, but using some better ways of measuring volume over time. So this takes what's called a typical price. So instead of using the closing data, it uses an average of those. And then basically it looks at a volume over period of time and characterizes positive money flow and negative money flow. So it is sort of an improvement probably on balance volume, I guess is the way that I would think of it. I don't use the money flow index very often. I use Chaikin money flow a lot more often because I'm just a fan of it and I've used it more often. I think either one of these, as long as you use it consistently, is going to upgrade your analysis of volume. And similar to what you look at with RSI, it's looking for spikes in volume, extremes in volume. The reason why I don't use this that much, and I think why people don't, honestly, I use volume very little in my work. I mean, if you follow me on the show and if you follow the charts that I send around, I rarely include volume, and that's just from my career from 2000 to 2024 in the industry. Volume has evolved, and I think it's become, personally, I think it's become less and less of a reflection of what we originally were able to do. Books that I read about volume in the 1960s and 70s and 80s talked about big moves on heavy volume, and that represented big institutions making directional bets on stocks. The markets in 2024 have a lot of different players. The way trades are reported, the way volumes are reported, it's all very different than it was when a lot of those original concepts were created. So I think it's less of a reflection about those big investors making big bets as I think it used to be able to be used for. Having said, if I was using volume, I would use something like the money flow index. I'd probably use Chaikin money flow. Similar, you can look at the chart school to see the differences between those different indicators. And again, reminder, use Chart School. It's free, and you can learn more about any of the technical indicators we have on our platform. Final question to wrap up today's show. Dave, how do you keep updated with the market? Newspapers, financial news, other blogs, etc. And I don't want to guess the age of the person asking this question, but the fact that you started with newspapers, which is awesome. I miss having a physical newspaper. I actually got away from that. And I fought it hard. I think 2 years ago, I finally stopped getting the Wall Street Journal sent to my house every morning. But it's so how I learned this. So just not having a physical paper. I still wish we could do it because I loved getting the pile of papers, going through the Wall Street Journal, Investors Business Daily. Those are my go-to. And then the Financial Times for a while. I was focusing a lot on currencies and non-U.S. markets. So I got the Financial Times every time. So what do I actually read? And I'm happy telling you about some of these because Stockcharts is a very technically oriented product, and I think rightly so. We don't have a lot of news coverage or other market commentary because we want to help you use charts more effectively. But I do a number of things. I look at the Wall Street Journal. I look at the online version every morning still, and I don't think I'll ever probably get away from that. I do look at other news sources, Bloomberg, CNBC. I contractually probably should have mentioned them first now that I'm a CNBC contributor, but I do use both of those still to track. And I think something like CNBC, again, I don't watch the TV version of it. Looking at news headlines that are happening, trying to understand when there's a big move, what might be driving it. I think that's a great tool that you have available for you. Years ago, as an institutional investor, you could call the trading desk and get that kind of color. The amount of color you have from those sorts of sources, I think, is pretty awesome. And then briefing.com, shout out to them. They do a really good job, and they actually do have some good technical commentary. I've subscribed to them from probably 2 decades, mostly off and on. But I actually used those originally when I was at Bloomberg because I found it to be a really good way of just seeing at any moment, like what's happening right now, what's moving and why. Briefing.com has been a really good place for it. I don't pay attention to a lot of it. You asked about other chartists, blogs, and other gurus. I try to pay less attention to those, and that's just because of my role as a technical analyst. If I'm reading other people's work too much, I feel like that clouds my own perspective, but I do pay attention to some of those top analysts. People like John Murphy, Martin Pring, Larry Williams, the analysts whose shoulders we're standing on, I think are really helpful still to just reinforce some of those basic premises of technical analysis. But those are some of the things that I follow. I'd be curious to know, for all of you listening, do you listen or watch or read anything that I didn't mention? Drop a comment, let us know. I'd be interested to know where you guys are looking at when you're not faithfully watching the Final Bar on Stockcharts TV. We have to wrap it here. Thanks so much for those great questions. As a reminder, keep all your great questions coming to our mailbag. We would love to hear from you for our next mailbag episode. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great weekend. We'll see you on Monday.